What's going on, everybody? My name is Zach Hartley, and one of my favorite places to invest right now is in the online learning industry. Now, the reason I like it so much is because internet is becoming way more accessible to people around the globe. People are needing to learn new skills in order to create better employment as automation and AI is taking over those entry-level jobs. And thirdly, the cost of secondary education is becoming so ridiculously expensive relative to household income. I think it is just being outpriced, and so alternative options are becoming more appealing, and that's why I'm investing in online learning. And one of the companies that I really like right now is Coursera, and they just released their Q2 financials. I just sat through their entire investor phone call. I've gone through the presentation, I've gone through the financials, and I want to summarize everything for you here, and I want to kind of share with you what I think of the company. I currently have a position in the stock, so I'm going to share that with you. I'm going to walk you through when I got into it and all of that. But I just want to kind of bring you up to speed, and I'm also going to highlight some of the red flags. So all of the problems with the company, any of the things that I am a little bit worried about, I'm going to talk about those as well in this video. So stay tuned and let's jump right in. Okay, so Coursera, if you're not aware, they trade on the NASDAQ under the ticker symbol COUR. They're headquartered in Mountain View, California, and the price as I film this video is $15.08. If you want to check out their website, or you want to take a course, or you just want to see what they're all about, you can go to Coursera.org. Now, the business model at Coursera is pretty simple. This is how they describe it. We partner with over 300 leading university and industry partners to offer a broad catalog of content and credentials, including courses, specializations, professional certificates, guided projects, and bachelor's and master's degrees. And so they're a course platform, but instead of allowing anybody to put their course on the platform, they partner with leading universities and industry partners to create curated, certifiable, reputable, and recognized content that people can use to improve their life. Now, I personally invested in both Udemy and Coursera back at the beginning of June. I posted this in my Discord chat. I posted why I'm invested into it, posted my technical analysis on both companies, and I share all of my trades and analysis in my Discord chat. So if you want to check that out, the link will be in the description to this video. But I've been invested in this company for almost 2 months now, and it's gone actually pretty quick. We are doing well on both stocks right now, and here's what it looks like. So today, they actually released the earnings yesterday after the market, and then today the stock was up 15.91% as I took this screenshot. I think it actually went up even a little bit higher as the market closed, but so far it's doing very well. Now, the balance sheet here, this is usually where I like to start when I look at a company, because the balance sheet tells you how the company got to where they are today. If the company does $100 million in revenue, but they have $1 billion in debt, that's not very good. If the company does $100 million in revenue with only $5 million in debt, that's a really good company that clearly has done very well. And it's a very different picture. And so you want to look at the balance sheet first so that you can put the income statement into context with regards to how much money they've raised, how much money they have, how much debt they have, and what that balance sheet looks like. And so when we look at the balance sheet of Coursera, this is really nice to see, because at first glance, total assets, $918 million, total liabilities right here, 292. And so total assets is more than 3 times larger than total liabilities. That is number one. That is healthy. That is good to see. And then on the top here, you can see that their total current assets, which is the assets that they could kind of realize on in the next year if they needed to, makes up like 80% of their total assets. And so really nice to see, really healthy here just from the first glance at the high level. And then when you start to dig in here, one line item that I always look for in kind of software companies and platform companies is deferred revenue. This deferred revenue line right here is really important, because this is customer deposits that have gone into the company for services that have not been rendered yet. So if a customer buys a 12-month subscription and they're only on month 3, that means that they have 9 months worth of payments that will be categorized here under deferred revenue. And this is really good, because it's basically companies or customers prepaying for services. It's a show of confidence, and realistically, it's not money that you have to pay back. It's just money that you have to provide a service for. And so I like it. It's always good. If this number goes up, it's actually a good thing here, as long as you can kind of keep that in mind and understand it, because it does increase the liabilities at the same time. But in my head, that's a pretty good liability. Now, when we move on to the income statement here, the first thing that I always look for is Number one is the revenue increasing year over year. And when you look at 2022 to 2023 for the 3-month period, revenue is increasing. Same thing when you look at the 6-month period, revenue is increasing. So in my head, kind of checks that first box. Gross profit also increasing year over year. Not by very much, but it is increasing. This is a little bit of a red flag because I'd like to see it increasing sort of proportionally to the actual revenue coming in. This doesn't look like it's necessarily proportional. As we move down here, we can see loss from operations, and obviously this company is growing very quickly. They're not profitable yet. They're trying to get to that point, but they need to increase revenue in order to get to profitability. What we do want to see though is that the loss is getting smaller, and that is what we are seeing. The loss each year is getting slightly smaller, so we are getting closer and closer to profitability. The revenue was up 23%, so it looks like we're on a pretty good growth trajectory, and at least now we have a path to profitability. We can see that as revenue goes up, gross profit goes up, and we get closer and closer to profitability. That is what we are looking for. But when revenue starts to slow down or revenue starts to turn around, the problem is we're going to see a pretty sharp sell-off in the share price because it means that profitability is getting further away. And so the company is going to be fairly sensitive to these earnings, probably for the next year to two. Now, when it comes to the actual breakdown of the revenue and where this money is coming from, I like it because they sort of have 3 different revenue streams, all of different sizes, and all of which are growing, which is super important. So number one, the largest revenue stream here is consumers just going in and basically buying the courses or subscriptions. Then they have their products and services that they're selling to companies and enterprises. And then they have their basically service where they are working with degree providing institutions, and they're taking a percentage of the fee. And so those are the 3 ways that this company makes money. All 3 categories are growing. I like that they're going after all 3 markets, and I think there's a huge opportunity there. Now, the red flags, I mentioned that I was going to talk about this. The red flags that I don't like are that lately the CEO and some of the executives have sold some shares. That is not a good sign, especially when the price was just continuously falling and falling and falling, and then it bottomed out, and as soon as it starts to go back up, they're selling some shares. I don't like that. Kind of pisses me off a little bit. And then underneath that, they're still unprofitable, but they're getting closer to profitability. They're still unprofitable. That is a problem with this company, is that they have not reached profitability yet. They have not kind of got to the point where they have a profitable business that could actually start to return capital to shareholders. And so until that point, I would really like to see them focused on trying to build that up. And then lastly here, they have a lot of stock-based compensation. And so the CEO's selling shares, they're paying their employees in shares and options. And so there's just a couple of things that I wasn't a huge fan of, but overall, I still like the company, and the valuation is actually reasonable. It has a 2.18 billion market cap, price to sales of 3.95, so basically 4, and I think this number might be a little bit out of date because I don't think it updated since yesterday when the financials were released, so it might be slightly better than this. The price to book though is 3.2, and they are experiencing 23% revenue growth year over year, at least in the last quarter, but they are losing money. However, I didn't mention this though. I listened to the conference call, and they did raise the outlook on revenue and EBITDA for this year. So they're actually exceeding their own expectations, which is very nice to see. And that balance sheet is actually pretty safe. So it gives me a little bit of comfort there. And I feel like this company isn't at risk of going under anytime soon. They are at risk of slowing down and maybe not achieving the growth that we hope for as investors. But as of right now, they're outpacing their own expectations, and they are driving forward, which is kind of confusing when you think about the CEO selling shares. And so maybe he knows something we don't, but something that I'm trying to watch very closely. Overall, I am bullish on the industry. I think this company is going in the right direction. All of the metrics are improving. Everything is getting better. And I think as more and more people get access to high-speed internet, more and more customers come online for these services, more and more people are going to be replaced with AI and automation, and they're going to need to upskill themselves, and Coursera is one of the places they can do that. They do have a healthy balance sheet. The stock chart is moving in the bullish direction, like I said. It's one of the reasons that I bought into it. If you want to see my analysis, you can sign up for the Discord chat, but I am watching to see how their industry peers do as well. Udemy is one of their closest competitors, another company that I mentioned I am invested in, and Udemy is reporting earnings next week. So I'm very, very excited for that one. I'm going to be watching that one closely. And if you want to learn more about any of this, all of my courses are totally free for 1 month on Skillshare. When you sign up with the link down below, you get a full 1 month totally free to take any course on the platform, including my stock market fundamentals course, where over 14,000 students have gone through the course. They've left over 400 reviews. They've spent over 2 million minutes of watch time, and the course is only 10 hours long, so you can do it in a weekend. I promise you, it'll be the best use of your time and the best free resource that you can find online. Thank you so much for watching. I sincerely appreciate it, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.